Welcome to Investing in Startups. I'm Joe Magyer. We recently hosted our 50th episode of Investing in Startups. I've learned so much along the way, and I'm hugely appreciative to all our amazing guests and listeners. I thought it'd be fun to have a conversation about some of the lessons that I picked up along the way and asked my good friend Chris Hill to come on and talk shop with me about investing in startups. We talked about how AI has impacted startups and venture capital, what I've changed my mind about, and investing in startups, both the craft and the show. Chris is an awesome host and interviewer, and I highly recommend his own podcast, Money Unplugged. Thanks again for listening. As ever, if you enjoyed the show, I'd be super appreciative if you could give us a 5-star rating on Apple or Spotify. Shameless, I know, but it helps to bring in even more listeners and great guests. And with that, turn it over to Chris. Let's start the show.
First of all, congratulations, because I think you and I talked about this a couple of years ago. Most people who start podcasts don't last more than a few episodes. So the fact that you've been doing this for 2 years is fantastic. And it also shows that it's resonating with your audience. And clearly you are still engaged in it, which is fantastic.
Well, thanks, man. I appreciate that.
All of that as backdrop. Let me go big picture here. What has changed in the last 2 years since you started this podcast? Specifically, what has changed in terms of venture and startups?
Well, the biggest is AI. And we can come back to some portfolio construction stuff that I would say has changed, that investors' expectations have changed. But AI is the short answer and the long answer. So the longer answer is that AI has reshaped how startups get funded, how they grow, and how they're staffed. I think if you look back at venture 2 years ago, the market was pretty ugly. Total amount of money that went into venture in 2023 was down about 60% from 2021. It's pretty gnarly pullback. Since then, it's roughly doubled. And if you go back to 2023, the amount of money in North America that went into venture was 150 million. And if you look at where things are now, just recently OpenAI had a single funding round. It was 110 billion. So we now have rounds getting done that are almost the size of the entire American and Canadian, but American funding market for venture from 2023. So I think if you go back to 2023 as well, you had market coming off from post-COVID high. We're shaking off ZERP, started the show 2024. And that's all the backdrop of it was a tough market for venture. It was hard for startups to get funded. It was hard for VCs to raise. AI poured gasoline on the fire. I mean, there wasn't really a fire. We could say there were coals that had been left out for too long and they were slowly getting chilled. And then AI just came in and doused them with gasoline. And so we've seen this huge rebound. And I think it's natural for people outside of venture or don't have their face pressed to the glass with startups to look at a lot of this and say, is a lot of this hype? Is this overblown? And I feel like in the last couple of weeks, a lot of public equity managers have realized, actually, no, there is some legitimacy. These AI tools, AI models, startups are all growing much faster than we realized. The products are much better than we realized. And more importantly, the rate of improvement is so much higher and better than what I think they appreciated, that it's really caught a lot of investors flat-footed. And, I think a good gauge for that is if you look at something like valuations for SaaS companies. Let's just use Salesforce as a proxy for that in public markets. The forward multiple of revenue that Salesforce goes for went from 7 back when I started the show 2 years ago to 4 today. That's a pretty big reset. 4 times revenue is basically code for investors collectively saying, we think this is a low single-digit growing business in perpetuity. Not a ringing endorsement from markets.
No.
And, public markets have waken up to this fact. I think that the other dynamic that we've seen that's AI-driven is that AI is enabling startups to grow much faster, both because of demand for AI services. So if you're providing AI to customers or services to AI companies, anything really AI market-centric has the potential to be exploding in revenue, but there's also efficiency. So these companies are growing faster, but they're also doing it with fewer employees. And so it's led to this dynamic where valuations and funding are getting really top-heavy. Like to go back to that OpenAI round, 110 billion, I think that would have been unfathomable a couple of years ago. I don't think anybody could have really imagined around that big. But it happens when you have 800 million monthly active users, and you got there from a standing start over like 3 years. Or if you look at business Monos that just got acquired by Meta, they went from zero in revenue March 2025 to like 100 million in December and got acquired for 2 billion. And when you have growth rates like that with small teams, it's understandable that valuations for startups that are true breakouts are commanding serious premium. So LPs have come back to market, albeit slowly. Startups have come back, venture money has come back, and valuations have all come back too, in different ways than they were before. But there's definitely been a huge rebound.
You mentioned the efficiencies, and I'm wondering if you think it's a little bit of a double-edged sword for startups, that there are all these benefits that bring these efficiencies. At the same time, it seems reasonable that investors who are thinking about funding rounds are asking the question, how are you different? If everybody has AI and everyone is being efficient with AI, does that make it a little bit harder to stand out?
I think there are a couple really good questions there, and I'll start with one, and you might have to steer me back to the second. The first, as far as like an interesting dynamic with returns on assets and returns on investment, is generally speaking, the more your business sits on top of other people's assets and platforms and capabilities, you have less control over your stack. Structurally, your business is weaker, but your returns on capital, your returns on assets, and your revenue per employee are usually much, much higher because you're not the one who has gone out and built everything. So, to use like a wine industry thing, because I grew up in that industry, if you're a full stack winery and you own the land, you own the vines, you own the production house, you own the barrel house, maybe you even produce your own barrels, you do this whole thing, you sell it all your own. The downside of that is it's incredibly capital intensive. The plus side is that you have full control. Now, if you flip it around and say, well, what if I am a winemaker who doesn't own any of that? I just buy juice, I lease facility space to get it done, I rent at the barrel house. The upside of all that is the amount of capital you put in is much less, returns on capital much higher. And the other plus is you can get to market much faster. The weakness is you have less control structurally of your business. And to bring that back to, because this isn't investing in wine, but investing in startups, to bring it back to startups, if you think of some AI companies that people will disparage as like an AI wrapper. So if you take something like Harvey, which is a legal tech company, which has raised what's recently raised evaluations that are close to 10 billion ish. Essentially, if you're cynical, you would look at Harvey and say, this is basically just repackaging ChatGPT and Claude and whatever the best frontier model is at the time, plus DeepSeek or Llama or some open source models. And it's just repackaging all that for lawyers in an interface that's friendly to them with some good integrations and plugins. And you could, if you're being harsh, you could say, well, that's kind of like the winemaker who doesn't own any of their own stack because they have a brand, but they don't control the underlying assets. And the risk with that is that the underlying asset producers, in this case, take Claude, can move further up the stack, move closer to the product, and rug pull you. And in fact, Claude has rolled out a legal plugin. Probably not great if you're Harvey, if you're a Legora, but at the same time, there is some defensibility for those companies with the customers they have. Like those customers, for example, they might say, well, it's true that maybe this month Claude is the best model, and last month it was Gemini, and maybe next month it'll be ChatGPT, and then month after it'll be open source DeepSeek. But I don't want to change models every month, and I can't train like all my non-technical employees to do this. I need a consistent interface, consistent workflows, plugins, integrations, storage, like all this stuff just needs to work. And I'll let you pick the models on the back end. So if you think of some of the biggest winners that have happened in the past couple of years, a lot of them are these companies that setting aside the big AI labs, which have invested, in some cases, 100 billion plus into building their stacks. It's companies like a Harvey or a Legora or Cursor or Replit or Lovable, like some names that a lot of people listening probably have some familiar with, that are just sitting on top of these other models. And there's a delicate balance there. And I think it's really important for those AI companies to get back to your second question as far as like defensibility and standing out and building a moat. Like it's interesting lately, VCs have started talking about moats. I'm like, cool, like welcome to the party. But it's neat to see. I think if you're building something in with deep integrations into daily workflows, some kind of data effects where the more data you have, the better the product is, network effects where the more users there are inside the customer who use the product or external that enhance the value for everyone else. I think those are situations where they're far more durable. And I think they have a lot more potential for being lasting and valuable. But those are tough questions that I think you need to ask when you're sizing up a lot of these companies.
All right, having started with the big picture, let me move a little bit closer to the podcast. And you've now had 50 conversations. And I'm curious the extent to which any sort of themes have emerged in terms of disagreements. You get 50 VCs in a room, you're bound to have some disagreements. And I'm curious, what are sort of the biggest fundamental disagreements that you've seen and heard in terms of how VCs approach investing?
In public markets, I think the biggest tribal debate that you'll see is growth versus value. And there are other dimensions that fund managers will compete on, but that's probably the biggest thing is like growth versus value, or maybe long term versus short term. Are we like super moat focused, long term focused, or are we trying to be opportunistic, make quick trades, et cetera? I have some strong opinions about some of those. Trading is hazardous to your wealth as an aside. But to bring it back to venture, I think the big dimensions of debate, the first is around portfolio construction, which may sound really mundane to a lot of people who don't invest in startups, but it matters a lot because venture is a business where power laws drive returns. And while that's true in public markets, it's even more so in private, where you can have a single winner that returns your fund multiple times over. And two-thirds of your fund, especially if you're investing early stage, let's call this like pre-seed seed. So live product, but very early traction. It could be a couple founders literally working from an apartment with a dog. Like that's the scale we're talking. The failure rate of those companies is probably two-thirds. It's really high. Like a lot of those companies, they zero out, they don't work. And this is the stage where I'm investing. You're investing before there's product market fit and there's a household name and they figured out distribution. So all that leads a lot of investors to say, well, I want to have a super diversified portfolio because I know I'm going to take a lot of losses, but by diversifying really, really widely, I increase my chances of catching a unicorn and getting good returns. The pendulum swinging the other direction, though, is a lot of people would look at that and say, fair and true, but by doing more deals, I'm by definition lowering my quality bar. So maybe I'm investing in 1 in 20 companies that I meet with instead of 1 in 50. And by definition, I'm setting a lower bar. Another dimension is the fewer deals you do, the more time you can spend supporting your founders. And there's research that shows that VCs and early investors who spend more time supporting their founders generate better returns. There are many ways to skin a cat, and I won't pretend like it's clear that there is a best way to do it. And it's interesting because we could get into this big philosophical debate about it. Because if you look at Monte Carlo simulations of which, I'm going to gloss over exactly what that means. We'll call it sophisticated statistical models. They review venture outcomes at portfolio levels. They all kind of point to this hyper rational world of, well, if you want to maximize your expected return, you should just invest in as many deals as possible. But I think the trade-off there, and again, that's how a lot of people view ventures, like we want to be super diverse. But on the other end of the spectrum, it's like, okay, well, that's a good strategy if my goal is to deliver average returns, like theoretical average. But a lot of people, self included, who wake up in the morning, don't get out of bed being pumped like, dude, I'm going to deliver the best average returns. It's going to be so sick. Like our returns will be so average. People are going to love it. That's just not what fires up a lot of these people. And then you run into the practical considerations of like, can you get into all the winners, especially if you're writing tiny checks? Can you see all the deals? Can you manage all the deals? So anyway, I think the concentrated versus we'll call it diversified, is probably the biggest. Another big one, which is a little like growth versus value, is the type of deal. Namely, we'll call it like hot deals versus non-consensus. And you have some investors who are run towards the heat. So they're like, look, we want to be in the best deals possible. And what's interesting in venture, when people say the best deals possible, they're not talking about valuation. They're just talking about, we want to be with the most prestigious founders. We want to co-invest with tier one firms like a Benchmark or A16Z. We want to be aligned with them because they have a history of outperforming. And generally, that's true. And we want to be in fast growing markets and companies with great traction. And valuation be damned. Like, we just want to be in the best companies. And truthfully, there's a lot to that. There are reasons why great founders with a history of delivering command a premium, because historically, repeat founders who have had a successful exit end up delivering better returns than other types of founders on their second company. Tier one venture firms do have really good performance. Great early traction is directionally indicative of things going well. So, like, all that is rational. The counter to that, people who are more non-consensus would say, cool, 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 all true, but venture markets are kind of a bit efficient and you're paying for that a lot of the time. Like, you're not getting that for free. If someone previously had $1 billion exit, it's known to the VCs and the founder is going to price their equity that way. So a lot of other investors, many of them come on the show, are like, look, we're not chasing the heat. We're trying to do deals that other people are overlooking. Maybe these are deals that the founders aren't in San Francisco. They're not in New York. They're in markets that other people don't care about. And we can find great opportunities because they're just overlooked and other people don't care. Maybe the founder didn't go to prestigious university. They weren't an early employee at Google or Cursor or Stripe or whatever the hot startup is at the time. And typically those valuations are much lower. And people get really, really religious, like fanatical about the end of the spectrum they're on. I think if I had to say something that like I've changed a little bit on how I think coming over the course of the show is thinking about which end of the spectrum like I prefer here. And part of the reason I raise that is there's been some great research published lately from PitchBook, and then Carta, then AngelList, who all published research in the last couple of months that basically said the average multiple on your investment that you'll get if you're an early stage investor, if you break out by valuation quartile or decile, so like cheap deals, middle of the road deals, expensive, and everything in between, directionally, they end up roughly the same over the super long term because the market is kind of sort of efficient. Like I said, like founders who have an elite pedigree and experience or great market, great growth, they command a premium. Founders who lack all those things are cheaper, but they're cheaper for a reason. So there's this irony where you have people who are all about run towards the heat and people who are all about non-consensus cheap deals. And they're like, oh, you got to have a cheap deal because that maximizes your asymmetry, or you just got to be in the best companies. But like the data says, actually, you're kind of ambivalent about this. It's really just about picking whichever companies are best for whatever level of price they are is actually more important than whether you're directionally picking one of those sides. So to me, that's an interesting dynamic. And I'm curious to see over time if people kind of pay more attention to the data with that, or they just stick with the points of view that they were mentored on. And they probably just will. But interesting for me to see the data.
Most of the guests that you've spoken with are early stage VCs, which makes sense given the topic of the show. But you have interviewed a handful of allocators who invest in venture funds. And I'm curious, what are a couple of the biggest insights that you've taken away from those conversations?
I think one is focus on repeatable edge. And you see this in all types of markets, but in venture, in order to outperform in venture, you need to excel at least one of sourcing good deals, picking good deals, winning allocations in competitive rounds, or adding value to founders after you invest. Like, you got to be good at something there. And not just good, but better than average. Being good at that in a repeatable, scalable way is harder than it sounds. And sophisticated allocators, when they're looking at VCs, they're probing to try and understand, are you outstanding in at least one of these buckets? And do we think you'll continue to stay that way or even improve? So, for example, with picking, if you have a history of picking well and showing good judgment, that's helpful. Now, that's a harder one to establish because you need a bigger body of work to prove it out, but it's helpful. If you look at sourcing, a good question would be, were they an early employee at a breakout startup? Like the PayPal mafia, which some people listening might have some familiar with. Like a bunch of early PayPal employees went on to become wildly successful VCs and founders. And it helped that they all knew each other and they kind of had a secret fire of a business model that they shared with one another, their networks, and they went on to crush it in many dimensions of life, like the YouTube crew, which actually was a spin out of the PayPal mafia, is much the same. The question on sourcing, though, is how durable those edges are and in which direction your edge is going. Is it getting sharper or dull? And that may sound funny, but sometimes if you came from an environment where you knew a lot of really talented people, your prior employer, that might be really helpful for fund one. But by the time you get to fund two, 4 years down the track, fund three, 8 years down the track, some of those relationships, maybe you're not at the cutting edge of where tech is. You don't know people working on the freshest stuff. Whereas some sourcing advantages improve from a dimension of, do you write collaborative checks? Do you play well with others? Do you partner with a lot of other VCs? Or in the case that, very openly I'm trying to build, do you have a media platform? Like, do you reach a lot of founders? Do you reach a lot of other investors? Do they want to engage with you? And does that flow into a right to win? And I think right to win is one of the biggest things that I personally underestimated getting in venture. And I think a lot of public market investors don't see from the outside is like 99% of the time when I'm talking to a founder, as the person allocating the money, I usually have leverage in the conversation. But once in a while, when that conversation flips, it's very obvious who's in control. It's the founder building the really exciting thing, and they've got more demand than they can meet for the amount of stock they want to sell. And the question is, they get to pick, like, who do I want involved? And if the founder doesn't see value in having you involved, or doesn't see your value better than the incremental dollar of another VC they can take, then you're out in the cold. You're going to miss the deal. So in that sense, sourcing and picking are really good. But if you can pick well, but you can't actually get into the deals, then the picking superpower is worthless. So just like in an equation, to go back to algebra, like if you multiply a sequence of numbers and one of those numbers is a zero, the whole thing is a zero. It doesn't matter if all the others are tens. If one of them is zero, in this case, like right to win, doesn't matter. So I think sophisticated allocators do a good job of sussing that out. The people that I've had on the show, they tend to focus on emerging managers rather than established. And obviously, I'm an emerging manager myself. My heart is more with emerging managers as a result. And frankly, I don't think the podcast world needs another show where every guest is someone who's already been on 20 podcasts and everybody knows what they're going to say. Even if they're brilliant, you might already know what they're going to say, and it's not all that interesting. I think having fresh perspective is helpful. In venture, when you look at the data, emerging managers dramatically outperform, on average, larger managers. And there are different reasons why that's the case, and this is true in public markets. It's emerging managers could be a combination of they're smaller, so they're not slinging as much assets. Like it's just easier to get into good deals when you don't have to shove a ton of money in. You're hungrier, you're motivated. The folks who've come on the show understand those dimensions really well, and they're looking for alpha. Not everyone investing in venture is looking for alpha. And that may sound like a funny thing to say, but a lot of people allocating money on behalf of others in particular, they care a lot about job security. And just like in other facets of life, nobody got fired for buying IBM. Nobody's going to get fired for putting their pensions money into A16Z or a Lightspeed or some other, a Thrive, just these huge firms. And good on them. And those firms have earned those reputations and those dollars. And like, if I had more than two thumbs to give them more thumbs up than that, I would. But, the data is pretty clear that that's not where great outperformance comes from. It's more on the emerging manager side. Now you have to take the time to actually find those managers that have something different. But yeah, I think all those guests have kind of emphasized those points of view in different ways.
I want to go back to something that you touched on very briefly earlier in this conversation. And I'm wondering, again, 50 conversations over 2 years. Have any of them, it sounds like they have, but if you could add some specifics around this, I'm curious about the conversations that have caused you to change your thinking or rethink your process in any way.
I can think of a few. One I'll start with, it isn't a process change so much as something I've admired or appreciated. Some of the more successful people who've been on the show, like a Hunter Walk or Seth Levine, they are incredibly kind, nice people. And they're humble and it shows. And they're that way on camera and they're that way off camera. And when I got off doing both conversations with both of them, I'm like, are we friends now? Like, I think we're friends. Like, they're just such good people. And, I'd like to think that has something to do with their success. And it's a good reminder that, you can be successful and not be a jerk, as obvious as that sounds, but it's worked well for them and it's good to see. More on the investing side, I think a couple that spring to mind are my conversation with Matt Conwell from Rare Breed Ventures. Mac's a super thoughtful guy. And the thing that he talked about that really made me rethink how I allocate reserves or follow on money. So that's money where we've already written the initial check, we've made an initial investment, we come back and add more and average up or provide a bridge or something like that. We don't really do bridges at Seaplane, we're more averaging up folks. But Mac made a really great point talking about emerging managers, where his point of view with saving money to average up was like, well, in theory, that's a good idea. But in practice, what can happen is you're allocating money into startups over what's called a 3-year initial deployment window. And you have some money set aside to do follow on investments. Well, the problem is you may not always actually get to invest in those follow ons because the absolute best performers, you may not have an opportunity to put more money into the next round. Either you don't have the contractual right to do it, or even if you do, whoever funds the next round, maybe if it's a big tier one firm who has a big ownership target, like, look, we've got to put 10 million, 100 million in the deal or we walk. Founder's just going to take that money and they're going to pull you aside and say, hey, Joe, I love you, but I got to make this space for them. So I just can't let you. I know on paper you have the right to put this money in. I really need you to do me solid and let this go. What are you going to do? Sue the founder? Like, obviously not. So you're like, okay, no problem. So there's a risk that if you invest in an absolute breakout home run, it may turn out that you can't add more to them anyway. So you're like, all right, well, why did we set this money aside in the first place? The other thing you raised was these companies don't raise money at the same time. And the average time between a seed and a Series A round is like 2.5 years right now. Well, that's a pretty long time. I may not have any reserves by the time they actually come around and actually raise. I thought that was really smart. And so when I thought about how I wanted to approach allocating reserves, what I changed towards is more of like a fast follow model, or instead of waiting 2.5 years for the next round, once you're invested, reality is you get better line of sight into the business. You see whether the founder's doing what they said they would do. You can follow along with the journey more closely. You see if the founder is receptive to feedback, if they actually update you. And if those things are true, and the business is going really well, in my experience, founders are usually pretty receptive if you go back to them and say, look, I'd love to put in another check, similar terms or some kind of terms we can figure out that you're happy with. I'm really impressed with what you're building. I'm super excited. I'd love to own more. Can we figure that out on terms that you're happy with? And I'm yet to have one of my founders say no to that. And that comes from a place of getting in, actually being helpful, showing you care, and earning a right to do that. But that insight from Mac for me was really powerful. Another was from Nikki Shivak at Blackbird. I don't think most people in America know Nikki, but Blackbird is like the Sequoia plus A16Z of Australia. Like, they're huge. They see everything. Their performance has been incredible. And by the way, another incredibly humble guy, despite being arguably the best performing investor I've had on the show. Something he talked about that I'll frame as kind of finding your tribe. He didn't put it that way, but I learned from raising my first fund that I'm a concentrated investor. That's my bag. I think people probably picked up on that by now. When going out and talking to potential investors, and I think this is true for anyone, it's not just about investing. It's like if you have a specific worldview and way you go about things, and it's really core to your business, product, strategy, you name it, going out and finding customers or partners who already share that worldview rather than trying to convince people of your worldview or how you see things is so much more effective than just trying to change people's minds. Changing people's minds is so incredibly difficult. Instead, you want to create a brand and you want to be known for your worldview, your approach, how you do things, maybe what your product does, what your strategy is, so that you can connect with people who already share that. You're not trying to convince them of, for example, to invest in early stage venture, or someone who loves super diversified VCs is never going to invest in my fund. So me having conversation with them is just pushing a boulder uphill. Instead, that time is much better spent just trying to find people like kind of in my tribe, at least philosophically.
Another theme, certainly a fun theme that has emerged with your podcast over the last 2 years. You finish interviews by asking guests to talk about a consensus view in venture that they think is bullshit. And I'm curious, what is that for you right now?
Ownership targets. It drives me nuts. VCs and LPs will obsess over how much of a breakout company or winner they own. For example, they'll say they want to own 10% of each company they invest in. And the big idea is that if they do really well, if that winner breaks out, that they'll do really well too. Directionally, that's true. But what I think fundamentally is being missed is that what matters isn't how much of the winner you own, it's how much of your fund, which is your capital, not the combination of other people's capital, how much your fund's capital, percentage wise, is invested in the winner. So, for example, if I own 10% of a big winner, but it's only 1% of my fund, well, that's actually not going to be a huge needle mover for my fund. It may not even return the fund. But if I own even just 1% of a huge winner, but it's 10% of my fund, then my fund returns will be gargantuan. They'll be huge. And it doesn't matter what percentage of the company I own. Now, I realize in venture, there's some nuance to like, well, the more you own, the more control you have, access you have, maybe you have more pro rata, but like those are marginal aspects of it. And I think it's interesting because in public markets, where I would say the average public market investor is vastly more thoughtful and experienced around portfolio construction and in venture, no one ever talks about how much of the company they own. Like, who cares? The only reason you might care about that is if you own so much that liquidity might be a problem. But otherwise, no one cares how much of Apple or Nvidia you own. What matters is how much of your fund is in that company. Like Nvidia, for example, like any individual fund out there is obviously going to own a tiny amount. But if you've held it for the last decade and it was a material part of your fund, then your fund has done insanely well. You're probably on the cover of a magazine. It didn't matter that you didn't own 10% of it, like Jensen. It's just really how much of your own fund. And that drives me a little bit crazy. It's the kind of thing, though, where it's such a pervasive opinion that I feel like I'm just shouting at the rain when I talk about it. But since it's my own show and you asked me, that's what I think.
Last thing before I let you go, because I know you're busy. What is something you're watching for the rest of this year and into next year? It can be an industry, it can be whatever is the next big question around AI. It can be in the venture world, the public markets, anything related to investing. What are you watching?
I think the most interesting thing from an investing standpoint is how systematic early stage venture investing might become. Right now, it's very much an art and very relationship driven. And because you don't have a lot of data to work with, it's hard for a quantitative strategy to be applied to the companies we're looking at. You don't have years worth of numbers to work with. Sometimes you don't have a year, you don't have a year's worth of data to work with. And so there's a lot of art rather than science when you're really early. There are AI tools that are helping early stage investors, but I think we're still ways off from the judgment and art piece. And to give you an example, I have an AI persona, basically an AI agent or custom GPT that I created that's trained on internal conversations with me, all our internal memos, research, and everything I could do to train an analyst as if they worked for me. And I call this persona Kirby after Kirby Smart because I went to UGA. Go Dogs. And Kirby, I actually have 3 different versions of Kirby. I have Gemini Kirby, ChatGPT Kirby, and Claude Kirby. And they're all trained on the same persona and all this information that I upload and provide to each of these different Kirby's. But what's interesting is they'll all give me different responses on the same startup. So I can give it a pitch deck for a seed stage company and they'll have differing opinions, which makes sense because just like in real life, you can have different doctors who are, went to great med schools, been doing it for a long time, give you different medical opinions. The same thing can be true in early stage investing and arguably more true because it's very unknown what's going to happen. You can't look at prior comps to necessarily figure something out. And it could be a decade before you know if you're right. The feedback loops are so long. So, in a sense, it's good because I feel like, well, what I do can still add value and probably can for the rest of my career. Is there a future state, though, where AI becomes hard to compete with? Yes. And an interesting point to that angle is more established firms. Like if you take an A16Z or these big shops that have armies of analysts, the playing field between little guys, like emerging managers, be included, and those firms has closed dramatically. I mean, what they have with brand and right to win and platform, like obviously small firms can't compete with. But as far as capability on getting up to speed on a name or using agents to help you do your work, better, faster, stronger, like all that's true and that's only improving. So I think you'll see the competitive gap close. I think you'll see fewer heads at a lot of big venture firms because you just don't need them. And I think these smaller managers will see their performance relative to big firms actually improve from where they've been over time because now they're able to do more work faster, be just much more efficient.
Well, congratulations again. And here's to the next 50.
Thanks, man. I really appreciate you doing this. And I love talking shop with you. It's cool that we've been doing this now for a very long time. And congrats on your own success. Thanks for doing this.
My pleasure.
Thanks for listening to the show. We really appreciate the support and would love it if you'd subscribe to the podcast on iTunes, Spotify, or your preferred podcast platform. One more thing. Investing in startups does not have sponsors, but I want to give a shout out to one of our portfolio companies, Atrios. Atrios enables companies to get warm introductions to potential customers and rewards the connectors who make those introductions. A study by Nielsen showed that referred customers are 4 times more likely to buy a product when referred by a friend. And I'd bet that goes even higher as AI slop starts to pile up in our inboxes. If you'd like to get warm introductions to customers or get paid to make warm introductions to your network, visit atrios.com to learn more. That's atrios.com. Thanks for listening.
Joe Magyer is the founder and managing partner of Seaplane Ventures. The content here is for informational purposes only and should not be construed as investment, legal, or tax advice. The opinions expressed by guests are their own and do not reflect the views of Seaplane Ventures. Our host, guests, and clients may hold investments discussed in this podcast. Please invest responsibly.